How does quantitative easing affect the stock market? Have you ever wondered how the actions of a central bank can influence the stock market? Let's break down the relationship between quantitative easing and stock prices in the context of capitalism. Quantitative easing is a monetary policy where a central bank buys government bonds or other financial assets. This process injects liquidity into the economy, increasing the money supply and lowering long-term interest rates. The goal is to stimulate economic activity, but how does this play out in the stock market? When a central bank purchases a large amount of bonds, it reduces the supply of those bonds in the market. As a result, bond prices go up and their yields or interest rates go down. Lower yields on bonds make stocks more appealing to investors. This shift encourages people to move their money from bonds into stocks, which often leads to an increase in stock prices. Additionally, quantitative easing signals that the central bank is committed to maintaining a supportive monetary policy. This reduces perceived risks and boosts investor confidence. When investors feel more secure, they are more likely to borrow and invest, which can further support economic growth and corporate earnings. These factors can drive stock market gains. Historically, we have seen significant stock market rallies during periods of quantitative easing. For example, during the financial crisis from 2007 to 2009, and again during the COVID-19 pandemic, stock markets experienced notable increases. The influx of liquidity from quantitative easing allows banks to lend more to businesses, which can lead to expansion and increased sales. Investors often anticipate that this will improve company revenues and stock valuations. However, it is important to note that quantitative easing can also lead to increased wealth inequality. The primary beneficiaries of this policy tend to be those who already own financial assets, including stocks. This can result in a concentration of wealth among investors and financial institutions, potentially distorting how capital is allocated in the economy. From a capitalism perspective, quantitative easing is a tool used by the government to stabilize the economy during downturns. It supports financial markets and encourages investment. While it can provide a temporary boost to stock prices and economic activity, it raises concerns about market distortions and long-term effects on income distribution. In summary, quantitative easing affects the stock market by lowering interest rates, increasing liquidity, and boosting investor confidence. This typically leads to higher stock prices. It serves as a mechanism for economic stabilization under capitalism but comes with trade-offs related to wealth distribution and market dynamics.